Good afternoon to the audience, judges, CFA Society, and fellow teams in the process. We are Paulina, Fernando, Enrique, and Pablo coming to present an equity research of Berkeley South de Seven, accompanied with a one-year target price. We hope you enjoy our presentation. What is Berkeley? Berkeley is an international spirits company, commonly known as Cuervo. It distributes, produces, and markets in more than 85 countries. More than 30 brands of alcoholic beverages, ready to drink, and non-alcoholic beverages. They are considered the largest producer of tequila in the world.
We issue a hold recommendation with a target price of 32.06 MXN, representing a 4.42% upside from the closing price of 30.70 as of the 5th of October 2018. We have assigned a 60% average to a discounted cash flow and a 40% to a relative valuation using an enterprise value to EBITDA multiple. Through our analysis, Cuervo will reach a 4.42% upside, this being less than the 8.20% risk-free rate currently in the market. This not reaching the premium needed to justify a buy recommendation. We have identified three main drivers that have led us to our investment thesis. Firstly, we will discuss the issues that have arisen from the company missing expectations. Secondly, we will dive into corporate governance. And finally, we will analyze the future growth potential for the firm.
Berkeley has been known for having a weak first and third quarter, and a strong second and fourth quarter due to Mexican and international holidays. We relate this to the geographical dependency to the United States.
We noticed a revenue growth deceleration in the last fiscal year, dropping from 32% to only 6%. This was mainly caused by two reasons. First, Berkeley's policy of increasing its prices every 3 years, and second, the US market reaction to said policy. We can see from the figure how the US market reacted with anticipated purchases before any price increase, causing lower sales in 2017. This is what we call the stockpiling effect. It was included in our discounted cash flow model, and we believe that the market might consider the stockpiling effect as a measure of inconsistency, and subsequently punish the price of the stock. Now let's move on and talk about ROA, where the Cuervo company has decreased the ratio from 9 to 7 in only 3 years. Now, they are lower than the average of the industry. This was caused simply because the assets are growing faster than revenue. We believe that for a company that depends so much on their inorganic growth, it is a very sensible outcome to show.
Cuervo has been blessed as well as cursed by the country's proximity to the US market. 68% of their sales come from this channel. Over the past year, Cuervo has experienced due to an appreciating peso and have not yet implemented hedging strategies to mitigate this risk. According to Oxford Economics, this appreciation trend will continue for the coming years. Fernando, can you tell us about corporate governance?
Of course, Enrique. 86% of the total shares are owned by the Beckman family, showing that the majority of the decisions are taken to maintain Cuervo under the family structure. We have observed structural issues. Since the IPO, Cuervo has been guided by two different CFOs, getting us to think that there has no structure to follow in a long-term period, just a short. Proximo Spirits, the main distributor abroad, has lost its CEO and co-founder this year. Then, Cuervo followed inventory shortage distribution in the US. Jose Pablo, why do you think this is still a whole choice?
Well, after all, we're still talking about the #1 producer of tequila in the world, aren't we? Besides, We expect that for any new brand acquired by the company to reach its full potential in terms of revenue generation after 5 years, meaning that the recently acquired Bushmills and Pendleton will have to wait until the year 2021 approximately to show this set potential, giving us a positive insight about the future of the company.
We see a recent influx of cash due to the total capital raised in the IPO, which is $900 million. This implies they can invest in brand acquisition and brand development. We see they're growing through cash and limited debt at the moment. Can you explain the debt, Pablo?
Of course. Talking about debt, they have the lowest debt to capital ratio among the industry, with only 17% and a healthy Altman C score. This generates the assumption that they can maintain this capital structure facing a low risk of bankruptcy, and also they still have some room for leverage if needed. Besides, they can brag about having some of the best liquidity ratios out there, such as the net debt to EBITDA ratio, which is only 1.4 against 2.9 of the peers.
Let's talk about vertical integration. Vertical integration is owned at 80% now. Cuervo wants to own 90% and leave only 10% to third-party vendors. We relate this to their distribution problems, and we see a cost diminution of 2%.
Now let's move on and talk about how we did this valuation. Basically with two approaches. First, with a 60% weight, a discounted cash flow model, and then a 40% multiple valuation. Once again, Paulina, can you please explain us a little bit more?
First, on the DCF. The DCF we use first 4 assumptions. The first, as the revenues are linked to volume seasonality and price increases. The second is consistency in the capital debt structure. The third is the tax rate will not be uniform over time. And the fourth, the Cuervo's dependency to international revenues. At perpetuity, we use the IMF's World Economic Outlook report, and for sales growth, we model price increases and volume seasonality, giving us a target price of 27.74 pesos.
We chose an enterprise value to EBITDA as the most appropriate measure to compare Cuervo with its peers. We conclude that due to Cuervo's miss on margins, we could not grant the complete industry multiple. To mitigate this miss, we calculated the mean between the firm and the industry, reaching an enterprise value to EBITDA of 15.24 times. Through this calculation, we reach a target price of 38.56.
Now, let's talk about the return over equity. Well, first I ask you to observe the asset turnover. As you can see, it tends to diminish over the years, reflecting that the recently acquired assets are yet to exploit its full potential in the upcoming years. Now, taking it into comparison to the competitors, this ratio proves that total asset turnover in Cuervo is more efficient than the assets related to the competitors. In net income margin, Cuervo is extremely close to achieve the same proportion of net income to net sales as the competitors. However, Cuervo still spends 21% of its net sales in marketing. Meanwhile, peers spend only 14%. In equity multiplier, as observed, Cuervo needs less leverage to finance its assets. In conclusion, we strongly expect an increase in revenues generated by the recent acquisitions in order to create a more competitive return on equity over to peers. Now, in our evaluation, we have incurred several risks to our target price. Now, let me introduce you our risk matrix.
First, geographic dependencies. As already mentioned in our presentation, 68% of the total sales come from the US market, meaning that any issue with distribution in this market might impact in a 7% to the net sales, such as it happened in 2018.
Political uncertainty. The Mexican market has been suffering volatility due to recent political decisions to cancel key investment projects. Cuervo, alongside the market, has been suffering from this.
Operating risk. Cuervo has not been capable of delivering its product in target markets. Therefore, there has been a there has not been capable of delivering its product in target markets. Then, the sales estimations are lower than expected.
In their analysis, Cuervo's short-term misses coupled with their long-term growth potential will achieve a 4.42% upside. This is still less than the Mexican risk-free rate at 8.20%. not reaching the premium needed to warrant the buy recommendation.
Thank you, and we open the floor to questions.
Good afternoon. Congratulations.
Yeah.
What do you think about the IPO prices of the stock?
To begin, I think the price was overvalued when they came into market. With recent downside, with them missing expectations, they went with a very high IPO, and with their missing on expectations, the market has punished this, and they've reached what they are right now.
Additionally, we can also say that past years before they came to the IPO, they came from a really high growth, and when they went public, and the next couple of years they grew below of what they were growing. So that's why they came out at a higher price, and now they're trading.
Let me add something to that question. For example, we can see right now an accumulated depreciation of the price of the stock around 25% by now, giving us to know, for example, adding it to the stockpiling effect. Why is this happening? Because somehow the market is punishing the price of the stock. Maybe that's an indication that, as my teammate Enrique says, it was overvalued at the beginning.
Given that you brought up the currency risk, could you elaborate into what is the cost structure in terms of dollars and pesos, and what is is there a benefit of depreciation? What is the size of exports rather than local production in US, etc.? Could you elaborate if there's a more profitable company given that has given the depreciation of the peso?
Yes, of course. 70% of Cuervo's earnings are in hard currencies, this being US dollars, Great British pounds, or euros. For each 5% in the depreciation in the Mexican peso, the EBITDA will rise in 100 basis points.
Additionally, we can say that through our talks with Cuervo, they expect that they are covered naturally due to their revenues are more in dollars and their costs are in pesos. So they think they are protected naturally by this relation. So that's why they do not have a hedging strategy, and they do not have any derivatives in that process.
I had a couple of questions for you, and then something one of you said during the presentation I wanted to ask about. You said they had not been capable of delivering their product in key markets. Can you expand upon that for me, please?
Yes, for example, second quarter is really strong on them. It's where they have their highest profits. However, for example, in 2018 second quarter, they were not capable of delivering their products to the US, for example, because they have a shortage in inventory. And that's due with also Proxima Spirit's responsibility. Therefore, there was a mis-expectation from the market.
And that's despite the fact that they have a lot of inventory on their balance sheet, though?
Yeah.
Okay. So that leads on, if I may, to my other question, second question. On one of your slides, you scored corporate governance at 75 out of 100. Now, you just said that they're pretty rubbish at delivering on inventory. You also said that some of their management seem to have gone missing over the past few months, and they only have a 15% free float. In most exams I've ever taken, if I score 75, I get an A. Can you explain why you mark it so high?
Yeah, of course. We have developed a corporate governance assessment table in which we add shareholders, management board, supervisory board, transparency, governance, and reporting and audit. For the time that we made all the analysis, we penalized shareholders since the 86% of the shares are within one family, means one choice. And then transparency and governance, since the high rotation of personnel, then that's the point where we That's where we took points from. Therefore, and the reporting and audit, in the management board also we diminished the points since the high rotation of personnel. So, sorry, to add, 75% means that it's in good, but far away from being perfect in corporate governance for our metrics.
Basically, that's one of the main drivers that drive our presentation. As you may have noticed, we have 3 pillars, which are not missing, well, missing expectations. The second one is the corporate governance, when we actually doubt about it, because of the way it's structured, with 87% shares owned by the same president of the company, and also with this score. Maybe the benchmark is A, but with this table, we notice that it's only good, but not excellent. And there's another level between excellent and good, which is very good. So it's kind of far, but not too far.
Then the 4.4% upside on the stock price, you mentioned that is way below the risk-free rate. So that means this is a negative Sharpe ratio investment. So why not a sell?
Okay.
Just go to the risk-free rate.
Yeah, we understand that, but our evaluation considers a potential for the recently acquired firms. Besides, from the IPO, they acquired a lot of cash and they still have 50% of that in cash accounts. So we didn't actually model any acquisitions in our discounted cash flow model, but we do have like a positive insight about the future of the company. That's why we try to represent the growth in terms of revenue generation of the recently acquired assets for the year 2021-2022, because we have to expect or to wait around 5 years to see that potential.
But why that doesn't is included in the evaluation? If you were expecting some interesting returns from that.
It is in the valuation. It's in year 2021 and 2022, but we did not want to model future acquisitions due to a speculative nature of those assumptions. We do believe that they have a lot of room to grow with the amount of cash they have in their cash accounts, and with, as my partner exposed, their 17% debt to capital ratio, leaving them a large margin. If they needed to raise capital through the market, they could do this and they could acquire a lot more companies. So it's a hold, waiting to see how these pillars and assumptions play out going forward. We did not want to do a sell recommendation because there is still a lot of potential upside with the company.
From a competitive standpoint within the industry, what would you like to see Cuervo doing more of, and what do you think they should have done that should be avoided doing?
For a competitive strategy, we're saying that Cuervo should diversify more. We can see this because they are entering more. They have 3 pillars they divide by 3 their markets. It's called United States and Canada, Mexico, and rest of the world. So that's why they bought Pendleton, and they bought Bushmills in 2015, Pendleton in 2018. These are whiskey companies, so they are reaching more to that older, mature demographic. Because normally the tequila is more than half of their revenues, and tequila is more aimed to younger people between 22 and 34. And whiskey is aimed to a demographic of 34 plus. So they are entering the rest of the world market that basically consists, their Proxima subsidiary is based in Dublin, and they are entering the European market, mainly the UK, France, Germany, and Spain. So that's why we're saying diversifying more the portfolio, and to stop having so high dependency on their third-party distributors. That's where they're having shortages.
So do you think that acquiring Bushmills and selling Julio Sequinta was accretive to the stock?
Yes, I think that based on the CAGR that whiskey has in the coming years, the firm is seeing that tequila is coming to a maturity in their growth, and they're looking to diversify through other forms of spirits, this being whiskey, and especially Irish whiskey and Canadian whiskey, one for Europe and one from Canada.
As a last example, Kraken, one of their brands, is one of the highest growing year over year of their brands. So it's Kraken, and the ready-to-drink area is one of their second highest growing year over year.